Hello there, acolytes of the cave, baby. Okay, welcome to lesson 6. This is the Strat. This is going to be kind of a jarring change for a lot of you, especially those of you that have been kind of religiously following the lessons up to this point. I've been, really hammering home candlestick patterns and chart recognition to you, and I'm going to flip it all on its head here today. So if this seems out of touch with what you've been learning to this point, that is in fact by design. So just a real quick history on what the Strat is. The Strat was originally created by a guy named Rob Smith. He went by Rob in the Black. Uh, you can find him on Twitter. He had a YouTube channel as well. Unfortunately, he passed on a couple of years ago, so he's no longer with us. But he came up with this strategy in, I believe, 2010. The origins of this was he was watching an FOMC day, and for any of you who have ever traded FOMC days before, you'll know exactly what I'm talking about with regards to what happens when the news comes out. So in 2010, there's an FOMC day, and it's very good news, right? There was, I believe, there was a very large rate cut that day, and so it should have sent the markets higher. So what happened as he was watching this, and this happens at almost every FOMC to this day, you can pick anyone you like, and you see this. The market initially shot up like a rocket, but then it completely crashed. Right, it lost all of the gains that it just acquired on the news, and then fell significantly below where it was before the news came out, and then it bounced back up and it started continuing higher. So this confused him a bit, right? Because if you get good news, the idea is the markets are supposed to go up. So why was that massive volatility occurring? And the reason was, especially back then, because we didn't have the amount of liquidity we have today, due to all the 0 day gamblers and day traders that kind of infest the markets today. There was an order vacuum, right? So nobody was doing anything leading up to this FOMC report, and then when it came out, everybody just slammed the buy button, right? They're just, oh, yeah, I'm going to get it, I'm going to get it, I'm going to get it. But again, there was a vacuum there, which just sent it shooting higher because there were no sell orders. However, as the markets ripped up, obviously people wanted to take some profits, but there was still that vacuum, and it would cause everything to just plummet down. And as it was coming down, the short sellers, the bears, would look at that and they'd be like, "Oh, okay, the market's totally going to go down. This is our opportunity," and they would slam the shorts. Well, this would create a vacuum going the other direction, and then the shorts would cover, and there's still the vacuum going in the upward direction as well, right? There's no liquidity anywhere, and it would just create this massive amount of volatility, until again, eventually it would kind of normalize. People would digest the data, and it would move further. But him witnessing this wild swing back and forth made him look at the way you approach technical analysis and the way you approach the way markets behave in a whole different manner. And this is really how the Strat was kind of formed. From there he expanded it out and kind of understood, how to integrate time continuity into it, how to get truth into it. But ultimately, that set him on a journey to find what he felt was the simplest way in order to trade the markets based upon what he believed were quote unquote universal truths. And this is really something that we're gonna talk more about as we get into. But again, this is just kind of a very high level overview of the history of the Strat. Um, Most of this lesson will be kind of at 30,000 feet. I don't want to get into a low level. We'll get deeper into the technical analysis later. But for right now, I'm starting off teaching you this versus some of the other strategies that you can use, just because this is really a very simple system that's proven over the years to at least be decently effective. Even though this is an existing system that I'm going to be training you on, what I'm going to talk about here as we get into some of the more, minute, or get into the minutia of some of these concepts here, is going to be modified a bit to fall more in line with my own trading style. So, full disclaimer, I myself, I don't use this system. There was a brief period of time where I did. It was fine. Like I said, I took a couple of good pieces of information out of it, but ultimately, I wanted a more elegant and more complex system, whereas this one is really focused on simplicity. So for me, it wasn't quite what I was after, but it's very useful to have. And if you understand how to do this, this is absolutely a system that will work to allow you to get to acquire gains. This type of system is particularly useful for long-term investors. And people that plan on holding for a significant period of time. This is less effective for people that want to just be scalpers and day traders, although it still can work. So every time I've taught this to my kids and also my mentee, there's a little postscript note in here. Once they've wrapped their heads around it, it really triggered some aha moments. So again, the purpose of this system, it's got three things, right? It's trying to be very simple. It's trying to remove as much signal noise as possible, right? Because there's just an enormous amount of data that you can acquire from a chart, and if you're not comfortable in parsing that information, it can be overwhelming, and it can really cause you to put yourself on tilt. And it focuses really heavy on prioritizing optimal setups. One of the other things it kind of does is it tries to train you to find optimal entry and exit points, which is a failing a lot of furus, especially on FinTwit, really suffer with. It's one of those things where if you miss up an exit, usually it's you're leaving gains on the table. That's fine, right? You still made gains. If you didn't make all of them, you still came out ahead. But what you see, especially with a lot of these younger traders that try to sell you newsletters or try to sell you their Discords or their Telegrams, they're really bad at picking entries because they just rely on traditional candle formations. They don't have a deeper understanding of things. And we'll go into the limitations of candle formations later. But, they when you pick a really bad entry, you find yourself more often than not trying to dig yourself out of a hole before you acquire gains. And what the Strat is attempting to do is kind of eliminate a lot of that initial pain of, trying to make up for the fact that you entered too early or maybe chased too late. All of those things. Why am I starting you off with this? Since I just spent, all those prior lessons trying to teach you how to do candlesticks and read patterns and stuff. And this is because one of the keys to trading is that everything should be absolutely as simple as possible to you. However complex you can handle things, that should be your limitation, right? So any ounce of doubt that creeps into your mind, any questioning of your thesis, whatever that is, it creates uncertainty for you. The thing that markets hate more than anything else, and you've all seen me say this over and over and over on my Twitter, the markets hate uncertainty. So if the markets hate uncertainty, why should you be any different, right? If you're trading with uncertainty, you are going to lose, right? Guaranteed. This system is certainly one of the more simpler ones out there. So, it just goes to, since you're just beginning your journeys in most of your cases, this is kind of a good way to get your feet wet. Maybe you can even start applying this into some of your paper trading and start understanding, what your trading style is going to be. So let me start off this whole thing by flipping you right on your head. And this is the thing that threw my mentee off as well. For those that don't know, this little section here is a postscript. So as I keep saying, up to this point, I've had you spend all this time learning the candle patterns, and I've basically been talking to you like it's your Bible for trading. And it should be important, but for the strat, throw it all out the window. Every last piece of it. Forget everything you just learned about it over the last few lessons. The reality is, if a person relies solely on candlestick patterns, you're going to lose. That's just a fact. Most people lose in general, but if you're just trying to trade straight off the candles, it's not going to work out for you. The patterns that you think you see, they're going to fail most of the time. Matter of fact, a pattern will fail more than 70% of the time. That's just a fact. What the strat seeks to do is remove all that signal noise and identify priority setups. It attempts to remove the confusion of having to memorize all of those absolutely crazy patterns out there. Some of the other arguments against technical analysis here, right? Again, the first one I'm kind of leaning into, especially as I talk about how you have so many failed patterns, is that technical analysis works right up until the moment that it doesn't. And for a novice or an intermediate trader, that's a great way to get chopped up. Another kind of downside to technical analysis is, it's a bit like reading tea leaves. If we're being honest, like we can all look at a different chart and see completely different patterns out of it. The same way that fortune tellers will see something different out of the leaves in tea, or you watch clouds up in the sky, like you'll see a shape and it'll be completely different to somebody else. So it is in some ways subjective. The other kind of argument against TA that a lot of people make is that it oftentimes won't work across multiple time frames, right? You'll see a pattern formation in, say, like a 5-minute chart, but if you expand it out to a 1-hour chart, the pattern disappears, right? What used to be a head and shoulders now turns into a cup and balls or something, right? It's just some weird ass different confluence, so you don't have that kind of continuity. As I say, most of the TA patterns are going to break before conclusion, and unless you're a very advanced trader, you're not going to detect that those breaks in pattern are occurring until it's too late. And then obviously, as many of you have learned, if you've gotten to this point and you aren't just racing through all the content thinking that if you absorb 10% of it, you're going to be able to figure this out and make money. It takes a really long time to master. And by the way, if you are one of those people that has just raced up to this point and you can't basically recite everything you've learned off the last 5 lessons, start over. Start the fuck over or drop out now. I'm telling you flat out, this is not a skill that you can half-ass. This is a learned skill. This is something that you have to master step by step. And if you try to just go into it just kind of halfway, it's not going to work. All right. Over 90% of individuals that try to trade markets, unless they're long-term investors, lose money. All right. If you're not willing to take it seriously, just bow out now. All right. So what is this trying to solve for if technical analysis isn't the answer? So the first thing it's trying to do is it's trying to remove conditional stipulations. Right. Again, get rid of the signal noise. Don't put everything on one candle. The other thing it's trying to do is it's trying to be functional in every kind of market. The vast majority of traders, especially the furus on Twitter, because those guys are all in their 20s or maybe early 30s, they've never experienced a true bear market in their entire trading careers. In general, their entire lives have been a bull market. Yeah, there have been little blips here and there, right? March 2020, when COVID was hitting, and Bill Ackman went on CNBC and told everybody that 60% of humanity was going to die because of this disease, where he was just creating fear, uncertainty, and doubt so you could buy up a bunch of stocks for cheap. Maybe some of them traded through the Great Recession, which was a different time, but again, it was very directional. It wasn't a very difficult market to trade. You just had to trade opposite to what you generally sort of believed. And then the moment it flipped back over to a bull market, it became really quite simple. And it's been a bull market for 15 years now. So the reality is, a lot of these traders that are charging you $75, $100, whatever it is, the only experience they have and what they feel it works is in a market that generally goes up. And I don't believe that that's really going to remain true for very much longer. The other thing it tries to just do is it tries to focus on what is immutably true and then drown out everything else that's not, right? It only looks for universal truths. And if it's not a universal truth, then it's not useful data, and the data should be thrown away. This is what lends to its simplicity. It tries to focus really strongly on time continuity, which we're going to talk about more as we get into this. But it tries to ensure that it's a completely functional trading strategy, regardless of your time frames, regardless of what kind of chart you're going to use. The big things it's trying to do is it's trying to teach you patience, right? It's trying to teach you to only look for optimal setups, priority type setups. And in so doing, it's trying to teach you, again, the how to time your entries so that they're more effective, how to time your exits to kind of maximize your gains. And then obviously the last thing it's trying to do, you don't know this yet, but you're going to learn it in the next couple of slides. It tries to remove the need to memorize, 1,000,000,001 pattern. And, one of the other big problems with trying to go off patterns is most of them are based on one candlestick setups. And the only time you get a trigger is the following candle. So there's a lot of guesswork that kind of goes into it. So anyway, this next slide here, just for a quick refresh, this is a candlestick again with all of the anatomy, right? You have your high, you have your closing, you have your opening, you have your low. You should all know this already. I'm not going to go too much into this. The one thing I'm going to point out is, there are a lot of different traders that take different ways they try to interpret it. A lot of traders out there only try to include the body of the candle when they're performing their analysis. I don't do that. Matter of fact, the Strat advises that you kind of focus more on the body than the wicks. I mean, it doesn't explicitly forbid the wicks, but it does try to focus more on the bodies. For me, I count the entire candle, including the wicks. If the wick was there, it matters because that happened, right? That is an event that occurred. The one exception being you will occasionally get a candle with just this insane wick, one direction or the other, that represents a little mini gap in liquidity from the high frequency trading machines. Sometimes you'll hear this referred to as a flash crash. Sometimes, there's just no liquidity upside and you'll suddenly see a stock, shoot up 4 or 5% in 5 seconds and then immediately come back down to where it was. Those you can ignore, right? Those are anomalies. But in general, unless it's a glitch, I count the entire thing. Anyhow, so what we're going to focus on today is really kind of drilling down and distilling the myriad of patterns and candles out there and just, again, distilling it down into just a few types in order to remove all the signal noise that a new trader would be overwhelmed by, right? Using this system, you don't really have to memorize all the various patterns. So, if you look up here, again, you've got your bullish patterns, your neutral patterns, your bearish patterns. And again, if you look at all of them are being triggered by a single candle, right? And unless you can interpret that single candle in the moment, it's going to be a suboptimal kind of situation for you. And then, also, I gave you guys an entire book on candlestick patterns, right? Just hundreds and hundreds and hundreds of them. Like, realistically, are you going to be able to memorize all of those? No, there's no fucking way you're going to be able to do that. And those are just the normal ones, right? We have all these crazy ones that everybody, has kind of come up with. And what these represent here is, the representation of how 75% or 70% of patterns, end up breaking. Like, how many times have you ended up in a trade, like if you've actively traded before, where this bullshit wedge where you're like, oh, that's a bull flag, and you go into a long because it's breaking out of the bull flag, and then it just collapses, and you're like, fuck, or you see the opposite with a bear flag, right, and you think it's going to go short, So you pop in there and it goes up, or it's consolidating. In the middle there we've got this bullish constipation one. It's kind of consolidating along. It looks like it's going up. You go long, fuck, it goes down, and then you go, screw it, I'm gonna go short, and then it bounces right back up. And you're like, fuck, I'm screwed, right? All of these things, like even if you see something that works really well. This bottom center one here, head and shit my pants, right? You're seeing a head and shoulders, and you go into puts at the right shoulder, right? Because you think it's going to keep. Man, sorry about that. My mouse is being very sensitive today. You go into puts thinking you're going to get the right shoulder, and it's going to keep continuing downwards, and then it just goes flat to expiration date, right? And you die by theta decay. Like all of these patterns that you see here. This is the kind of stuff that just absolutely annihilates you as a trader. And the Strat is attempting to kind of do away with a lot of that. Again, while I personally don't use this system, it's proven overall effective at kind of combating that. A lot of that just has to do with the fact that this system is really simple, and because it's stripped down to base level components, it's got really easy flow. Right? What it attempts to create are universal truths. So this isn't to say that you'll never use advanced patterns in the Strat. It's just to say that this is a way to possibly spot some crazy ass patterns before they happen, because you're not looking specifically at them. If that makes sense. And if we accept as true that most of the time patterns will fail, if you see the pattern forming and know that it's likely to fail, you can take the contrarian trade to the pattern and see some gains. Remember, all pattern trading is, by its nature, it's subjective, right? You've all heard me say before things like a failed head and shoulders pattern is the most bullish pattern of all trading, right? That's 100% true. But why is it true? And it's true because most of the time that pattern will fail, representing super easy gains to acquire. So a lot of what this is trying to do is it comes up with a simple way to identify your target and tries to prevent you from missing your mark by going over. It explicitly forbids more complex analysis like Bollinger Bands or Elliott waves, which, if we're being honest, you aren't ready for anyways, because those are impossible to keep simple. And it's my opinion that harmonics are kind of voodoo. Those techniques are highly subjective beyond even just normal TA. But again, the Strat forbids subjectivity. It's also worth noting that Elliott died penniless. So back to this slide. Let's see. Remove signal noise, talked about that. Targets, talked about that. Basically what you're doing is you're aiming for an 80 to 90% target accuracy, right? It doesn't use conditional stimulations. Let me define that. So think things, when I say conditional stipulations, think things like golden crosses, death crosses, things like that. None of that shit exists here. I touched on universal truths, but just to drive this home, anything that is not universally true does not exist in the Strat, right? No subjectivity is allowed, because that's the only way to get rid of the noise. So again, let's dig in here. So to repeat, the first thing we do is take everything that you've just learned about candlestick patterns and throw them out the fucking window. You don't need them here, all right? With the Strat, there are only 3 types of candlesticks that you need to be made aware of, all right? The first is called an inside bar, or if you're using an algo on TradingView or some of these other platforms, it's oftentimes referred to as a type 1 bar. All right, so here's the deal with a type 1 bar. The second bar in a chart is too weak to make a new high, but it's also too strong to make a new low, right? Whenever you see an inside or a type 1 bar, the universal truth here is that the stock in question is consolidating. You can use whatever time frame you like for this setup, but you're most often going to be wanting to key in on the daily and then mixing it with a different time frame. This setup is the biggest thing you want to look for if you're a long-term trader or a flat-out investor, right? This setup is crucial for people that want to trade on fundamentals rather than technical. So if we look at this example of setup 1, what it basically means is this candle here is inside the prior candle. So it's an inside whatever, an inside day, an inside week, an inside month, whatever your time frame. This is the easiest thing to find, and what most of you should begin your journey kind of looking for, right? Inside bars are a great signal that something is about to happen. Now, you don't know what that something is per se, but stocks are always either racing or resting. And this tells you right now it's consolidating and it's resting, and it's going to get ready to race. This is what makes it interesting. This basically tells you that this should be on your radar, and that you have balance and equilibrium between buyers and sellers in the moment. So it's super simple. Again, the entire candle with wicks completely inside the prior one. So this second type of setup, this is called a directional bar or a type 2 bar. You'll also sometimes hear it referred to as a one-side bar. So this pattern forms when the second bar takes out one side of the previous range. This is a signal that you have a direction that a given stock is going to move. It's letting you know that some sort of a break has occurred, either a breakout if it's moving higher or a breakdown if it's moving lower. Again, remember, every time we talk about the three types of candles that we're going to talk about with the Strat, we're only talking about evaluating two candles at a time. The current one that you're evaluating and the one that immediately preceded it. So in this example here, if we look at this here, we have the candle's prior high, you have the candle's prior low. When you were able to break one side of that prior candle, it becomes directional. So if it breaks to the upside, we call it a 2 up. If it breaks to the downside, it's referred to as a 2 down. If you find a type 1 candle which turns into a type 2 candle, this is telling you that we are starting to have the knowledge necessary in order to figure out the upcoming direction. So if you look at the second example on the right there, you're seeing one with an awful lot of 2s, right? Where it's busting out one direction or another. It starts off as a 2 down, consolidates a little bit, and then you see a series of 2 ups, and then you start seeing 2 downs again. Because, again, remember, me specifically, I count the wicks. I don't just count the bars. So the one on the right is a really kind of good example of a series of type 2 candles that, as a trader, you're going to want to look for, because as you see these series kind of coming in, you're going to want to be riding that wave. So the last type of candle we have is called an outside bar or a type 3 bar. In this scenario, the candle that you're evaluating takes out both sides of the previous range. And what this is signaling is that there's an active attempt to reverse the directional trend and flip the trade. What makes outside bars special is that they're the only way that you can really start trying to hone in on what the potential force of an expected move will be. So if in an inside bar candle, and we know that we're stuck in a range, and in a directional candle, we have our direction. What we really like to see is this type 3 situation, because the prior 2 just let us know that a move is happening or what direction it's going to go. But these type 3 candles here give us the extra data point of being able to figure out how strong this trade is going to be. So one thing I want everybody to note here is that you can never have a type 3 candle unless you have a failed type 2 setup. Ever, all right? This is, again, a universal truth. You always have to start with a type 2 before a type 3 can occur. So a really great real-world analogy of this phenomena that I'm sure you've all experienced if you're active traders is, let's say you're in the middle of a trading day and everything is going great for you, right? It just, man, everything's coming up millhouse. You're green as green can be. You think, okay, I'm on easy street, and then you go to lunch, or you get distracted and play a video game. You're not being as active as as you observe the trading day as it goes on, and all of a sudden you end your day trading. Your day, it ends red, and you're like, what the fuck just went down, right? What happened is a type 3 here. I guarantee you, anytime that you've started off in one direction, and then by the end of the day you were in a completely different spot, if you go back and look at your candles, you found there was a type 3 candle that flipped and signaled to you that this was happening, and you probably should have maybe considered adjusting your strategy as it went through the day, right? So you'll often hear me specifically talk about this sort of setup as an engulfing candle, right? That's the more mundane term for it. Here in the Strat, we don't like using that phrase, but again, I don't use the Strat, so that's why you'll hear me refer to it as. If you'll recall, I did a breakout session on Palantir, PLTR, where I kind of explained my rationale for a Palantir short based upon a bearish engulfing candle. That was a type 3 kind of setup. Now, how does this tell you the force of a move? If you have this setup and you have a fail or a breakout, you absolutely know you're going to the next level based upon the prior candle. And this is really the secret sauce to the Strat, right? It's predicated upon the truth that if you break one level, then you simply move on to the next one, right? Whenever you have a move, you just look for the next highest or lowest point on the most relevant prior candle on the chart. If we go back a slide to these type 2s here, let's look at the bottom right example there. And let's say that the next candle to the rightmost of that one there is a type 3 candle, right? It blows out the top and the bottom of that candle, but the candle ultimately ends up finishing as a red candle. So conveniently, all of these lines have already been placed there. So if it already blew out the candle immediately preceding it, then you know it's going to go to the next level that something touched. So if you go back 1, 2, 3, 4, 5, 6, if you go back 7 candles, there's a green 2 candle with a bottom wick. You know it's going to touch the bottom of that bar. If it blows that out, then it's going to the next level beneath that, which is the preceding candle, the top of the preceding candle before that. If it loses that, it's going to the wick of the preceding candle before that. You can work your way backwards through all of these things and find your levels. And this is almost guaranteed in terms of how it works. As long as it keeps continuing, you just keep hitting your levels and your levels until you see it fail to hit a level. And that's generally your sign that maybe the trade is kind of exhausting, a direction might be able to flip, and this is helping you kind of identify where your exit can be. But more importantly, if you know the direction and you know your levels, then you can start gauging the velocity of the trade and how much you're going to earn on it based on how many levels you're going to be able to take out over the course of that trade. We've been talking about up to this point in terms of universal truths, or what we call actionable signals, right? So those are your 3 types of candles: your inside bars, your continuations, your reversals. The second universal truth is time frame continuity. And what this is attempting to do is it's trying to locate the best setups based upon the concepts of continuity, right? You achieve this when no matter what time frame you're looking at, you still have an alignment of strategy. So you would ideally find a setup that works on every time frame you use, from 15 minutes to monthly, right? This tells you if you're trading with the trend, right? And you guys have heard me say this over and over: don't fight the trend. If you have this kind of continuity over multiple time spans, then you know that you're in something where your thesis is probably generally good. As a new trader, you're really going to want to key in on days, weeks, and months, as opposed to the 4 hour, the 1 hour, the 15-minute, whatever that might be. The third universal truth is broadening formations. So when we're talking about broadening formations, we're talking about ranges on a chart that will continually expand on both ends, right? So we're talking about continual higher highs and lower lows. And this brings up the idea of pivot machine guns. And what this is generally going to signal to you is it's going to signal chop within a trade. And generally chop is pretty bad, but if you're in a broadening formation, especially if you're getting further out from it where the range is significantly wider, this allows you to be really agile and I time your shorts, time your longs quite appropriately to profit on both directions that an individual equity is going to move. A quick set of warnings here about this system here. As you've heard me talk about it, I'm sure that you're kind of, the gears are turning and you're starting to think that this entire system is based upon the premise of identifying reversals based on it's something called the combo sheet. You're going to see this in a couple of slides. You haven't seen it yet, but you're going to assume that you're just trying to find reversals, and that's a huge part of the system. But you're not going to be successful if those are the only things you're looking for. You really need a confluence of those three universal truths in order to succeed. Otherwise, the strat is probably going to fail you. Again, so first truth, actionable signals. We've seen this pattern before a few times. Get your ones, get your twos, get your threes based upon what types of candles they are, right? This tells you trend, this tells you pattern. We've kind of beat that to death. This one here, so this is what we call the combo sheet. And this is something that Rob Smith invented quite some time ago. And basically what this is you're looking for 2 to 3 candle setups that'll really kind of help you hone in on validating what your trade should be, right? And you're looking for very specific sequences within the strat in order to justify taking a position with certain high confidence. Again, there are no stipulations in this. It's based entirely upon universal truths, and it's always useful in every market condition all the time, right? If we look at a few of these here, starting with the top left, right? 212, bullish continuation, bullish reversal. You're seeing a good example there. You've got a type 2 candle, which means the candle that you don't see to the left of it was defeated one direction or another. In this instance, because you see that the type 2 candle is green, you know that it's a 2 up. The following candle is an inside candle, right? That's so you've got an inside day or an inside month, whatever it is you're looking at, whatever time frame, but you know that you've got consolidation. Understanding as the candle goes on, that's going to give you some directional knowledge. In the example in the top left, you kind of enter towards the top of that inside candle, expecting a continuation, and then you see another 2 candle at the end that touches the level of the prior candle, right? It's always going to look for the next level that it can touch off some other candle in its history. And none of these charts here, go back 50 candles, but I could pull up trading view panes for just about any stock and show you 212 entries, 212 patterns that kind of guide you towards just identifying, and you'll see it hits every single level along the way until there's a reversal. The other opposite being that in the middle up at the top, you've got your 212 bullish reversal, right? So you've got a bearish candle to start with, but the second candle, the inside candle, is finishing at a higher point, right? So it's finishing up near the top, and it's signifying that it's probably got some sort of a reversal coming in. And then sure enough, in that example there, as long as you entered long in that trade, even though the prior candle was a 2 down candle, the one implied a reversal of sorts, and you could ride that trade up to the top of the prior candle that was red. I know this is all kind of complex. I promise you, if you sit here and you stare at these charts long enough, they start to kind of make sense. In general, the takeaway that I want you to get out of all of this as you stare at this slide, as you stare at these charts, is that you understand, first off, that again, I have to reiterate, this is usually best for a daily time frame setup. This doesn't work as well on 5-minute, 10-minute charts. You can use it, but it gets a little wonky. But the beauty here is that it tells you what your targets are. You're no longer having to guess or rely on some VWAP figure or an EMA line. Again, you're killing all of that signal noise. To start with, again, most of what you're going to see that you're going to be able to act on, they're either going to be 2-1-2 patterns or they're going to be 2-2 patterns. There are a lot of different scenarios here, but if you can master those 2 types, you're going to be fine, right? The strongest moves are always where you have these single 1-bar inside setups where you break the prior day. When we look at the 3-bar or outside day setups, they're a little more tricky. A lot of times you'll see an outside day immediately after an inside day, So that's something to kind of look for. When you're trading an outside day pattern, just be aware that it's pretty rare for there to be a large continuation following one. When we talk about these outside day patterns, this is really more geared for day trading because on a swing, the risk to reward ratio of a reversal is just too high. So, again, remember that I'm telling you that this strategy is mostly geared towards people that are going to be doing swing trades and longer term investment. So when we talk about these 3-bar kind of patterns, the 3-2-2 bearish reversals, the bullish reversals, things of that nature, like, that's going to be less effective for what this system was specifically designed for. So this particular chart here is just kind of a continuation of that. Again, this goes into, we're trying to remove the signal noise. So the best way to use this is to only use 3 different levels, right? A break of the prior day, the prior week, or the prior month. And what you're looking to enter are on our 2 to 3 candle setups. So again, use the Canvo sheet as a guide, right? You're going to want 3 to 4 quote unquote clean candles to provide confirmation that your trade is in a good spot. And remember that you're always targeting the nearest levels. As a general rule of thumb, and I've probably said this a couple of times already, but I'm going to reiterate it again, use at least 4 different time frames when you're evaluating your trade. Line up the scenarios and the reversals on these multiple time frames. If there's a reversal on a larger time frame, you know to look for similar on smaller time frames as confirmation. Again, time continuity is a huge deal here. If you have continuity on the month, on the week, on the day, and on the hour, like that's what you call total continuity, right? You're completely lined up. It's simpatico. That's how you know you're in a really good setup. In general, even though there are a lot of these different combos, and you can go on, do a search in Google and find various combo sheets for the Strat. They've certainly expanded it over the years. But, just as a beginning spot for you to kind of practice this method of trading and see how it functions, the setups you're generally going to want to look for are the most common ones. Again, you're going to want to look for 2 1-2s, you're going to want to look for 2 2s, and you're going to want to look for 3 1-2s. Don't bother trying to catch a 3 2 down 2 up bullish reversal, right? Those, first off, those are incredibly rare. Second off, they're kind of hard to spot. So you really shouldn't just be bothering with that until you're more comfortable with the more basic stuff. The big truth that we're going to be talking about here is broadening formations. And these can be a lot of fun. Especially if you're a day trader. This is the section of the Strat that really kind of shines on the shorter time frames. I mean, it absolutely works, again, on swing trades and longer term investments. But, if you're just trying to use this system on an intraday level, this is always something you can kind of look for. And when we talk about broadening formations, we're talking about a series of higher highs and lower lows. So what this is basically saying, and there's a good example up here in the graphic. Go ahead and study it. Spend a lot of time on it. It's saying that sellers are stepping in at the highs to drive an equity down to a new low, right? Eventually, the buyers are going to step in at the lows, and they drive it back up to the new highs that are slightly higher than what it was before. Eventually, those buyers exhaust themselves, the sellers take over, and they knock it down again. And except this time, it goes just a little bit lower, and the cycle repeats. Now, very early on in a broadening formation, there's not a lot you can do with the trade. You're just going to get chopped up. You definitely don't want to be involved in it at the early part of the bullhorn. But as these broadening formations kind of take hold, it gives you significantly more kind of range in which you can trade your longs and your shorts in order to extract gains going both directions. And you will usually find just about anything you look at, if you start seeing broadening formation patterns, it will respect those broadening formations for quite some time until there's some sort of a seismic shift that kind of adjusts it and kicks it out and does a reset. And this is usually going to take the form of it's hitting a higher high, and then it just breaks out and just keeps going. It doesn't respect the line anymore. Or, the sellers just completely dominate the buyers and it breaks down off the lows. When you see that, your broadening formation pattern is over, and you should probably start looking for a different one. I'm going to do a little post edit here because my student had a really hard time kind of grokking this just based off the original video there, because it was all on a slide deck and I couldn't really mark anything, and she wasn't really getting it up until the moment that I was able to get on a live meeting with her and sort of walk her through it in a way that I could mark it up and help her understand it. So this again, this is the combo sheet with most of the common stuff here. So if we look at this is a bearish reversal. So your scenario here, your entry is the second that it breaks. Does that make sense? So the strat is going to teach you that you're just going to go to the very next candle, right? And if you have another candle, let's just say there's one right there, then this becomes your next target, right? And then there. So when you have a break, just clean. You just get your targets and you just run your levels there. So the trigger here in the actual trade is when you've got this clean entry here and then takes it down to this next level. The big takeaway here is this removes the guesswork, right? Because again, your initial trade was only trying to get from the inside day candle to the bottom of the prior candle for number 2. That was a trade. Anything else is just gravy. You're just seeing if you can get continuations to the next levels. And the big reason why the strat works so well, again, on longer time frames, when we're talking days, weeks, months, et cetera, is because it allows for a lot more precision in terms of identifying those levels and trying to achieve those continuations, right? Whether it's bearish or whether it's bullish. Again, your initial trade was only supposed to be trying to get to the level of the prior candle from the inside day, right? From the inside week, from the inside month, whatever that inside one candle is, getting to the next level on the prior candle, like that was your win. But this allows you to kind of be greedy. And as we go on with the next lessons here, we're going to start talking about candle by candle kind of evaluations, and this will really kind of drill in on top of what you're learning here in terms of helping you identify just how far you can take it. And just to drill this in here, so when we talk about, this instance here, this is a 2-1-2 reversal. So this candle here, this is a 2 up because it's a green candle, and then we had an inside day, an inside week, whatever it is, and then we had a 2 down, right? That was a bearish reversal going in there. The opposite could be true, right? We could have had a 2 down with an inside day, and the moment that the inside candle started breaking trend, that was your signal for entry for a 2-day continuation up. Now, the other one that you're going to see a lot of, again, I'm just reiterating because, again, this is a postscript because this was confusing my student a lot. You have these 2 days, right? So you had the inside day here. This didn't really matter. You had a green 2 up day, and the moment that your following day, your candle broke on one side going to the downside. So the moment it broke the prior day's low, that told you that you were getting a directional candle. It was no longer an inside day. It was a directional candle. It was going to go down. And then, so this is how you got your intraday reversal. And then the level you're looking for in this instance here for this particular trade is the bottom of this prior inside day here, right? And if there was another candle down here, it was off to the left somewhere, this would have been the next level, and then down here, continuing onwards, right? So again, the whole point of the strat here is taking the guesswork out of where you time your trades at, right? It's based on precision and understanding every level to understand, identifying every candle that a trade could touch in a continuation or a reversal. And again, all of these that you're seeing here on this chart, these are very basic, right? You're only seeing two candles. I could pull up a trading view window that, I could go back 4 months to identify a new position to kind of do those levels. And I might do another post edit later for that. Kind of another postscript here. This is another kind of a live example here. So this is Alaska Airlines, and this is a daily chart. So one thing, if you guys are on the TradingView platform, TrendSpider has something too, but I don't know what it's called. But on TradingView, if you go into indicators and you type the Strat, I think it's called Learning V2 or something, there's actually, it's a free indicator set that will actually give you the candle numbers, just implant them for you onto your chart so that you don't have to try to figure out what type of candles you're looking at on a certain day. But in this instance here, what I'm wanting to point out, this was a good example here. So here we have a 2-up day right here. See? So let me go back a little bit. So we had a 2-up day going into a 3-day, right? Remember, 3 is always representing, 3 tries to represent a reversal of trend. However, we ended up with another 2-up day. We had an inside day here, right? A level 1 day, inside day. And then it signaled a bearish reversal. So right here, if we go into it, we see that the moment we had signal that we were going to get a reversal, we could enter the trade here. The 2 down day that came through, what did it do? It touched this prior candle right here, right? So, and had it continued, our next spot would have been 72.70, and our next spot after that would have been 71.63. Definitively, we would have seen 70.93, and we can just keep walking it all the way back, right? As long as that trade continues. However, in this particular instance here, so this was last Thursday going into Friday, it ended up being a 2-up day. But the entry to your trade right here was the moment it started breaking the continuity of the prior day's trade, which told you that you were getting a 2-2 reversal. So you enter the trade here, and where did it cap out? Where did it top out? Look, right at the top here, the next level, over a few days ago at this 2 here on February 4th. Now, Alaska is trading near all-time highs, so this isn't the greatest example here, because I would start talking about continuations, and we would start going back through the chart trying to find the next levels that it would touch. But in this case here, because Alaska is at an all-time high, this doesn't necessarily work. There's nothing for it to touch continuing. So this is what we call price seeking, right? It's an uncharted territory, and this is kind of a limitation of the strat. When we're in price seeking territory, we don't have any levels that we can specifically target, unless there's a broadening formation that we can look for, which we also don't have here. So yeah. I'm going to do one more example here. So this is an example of a trade that I might be making a trade of the day in the very near future. So this is Merck. This is ticker MRK. And again, we're still just on a daily chart here. So if we zoom in here, we have a 2-up day, right? And then we had an inside day that was showing reversal. The moment that we got the show of reversal, if we enter the trade right here with a bearish bias, we got the 2 reversal. So the bearish reversal did hold true. What did it take down to? It went down to the prior day, the low wick here. It kind of touched on there, right? And then the next day was another continuation. It did not break going the other direction, and look where it settled here. It's once again settled at the low wick of this day here on February 4th, right? The bottom wick of this 2-up day. So what I would be looking for in this particular trade, and this is why I might call this one out. I might look for an inside day that's signifying upside bias, because if I get one of those, let's say it caps out here at 88.28, I know my first level is going to be 88.64, which is this prior one. The next level after that is all the way up at 89.58, right? The next level there, we're going to 90.36. We'll go from there to 91.04. But the interesting thing here, the interesting part of this trade here, and why as soon as it starts reversing, I'm gonna start looking for it. If we zoom out, the next level, after it bypasses that, if we get a reversal continuation, right, we can go back a long ways. The next spot that it's going to touch is going to be right here at 94.68, right? That is a significant gap of upside potential that's going to come in with this trade. So I'm going to be keeping an eye on this one in the coming days, looking for that, because I'm going to want to see some sort of a continuation that's going to get me to this 96.47 level. And then from there, it gets slightly less interesting, right? You know, we can get to 95.26 and so on and so forth up there. But we've got this gap all the way up to 98.07. This is a potential major trade right here. This is an incredibly high potential trade as long as we can get that reversal. Now, there are some other factors at play here. We're seeing that Merck is trading at 52-week lows. You know, the trend has been down for quite some time. So it's entirely possible that this trade never actually happens, right? If it just keeps going down, 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 like how, let me go to a wider time frame here. Like, where is it going to go? So if we look at it here, the downside, it could get down to 84.95, which is another $3 down. I mean, that could be a decent short. You know, so we just start working our levels downwards from there if it continues on. But I would be more interested in this trade from an upside perspective, right? Especially as it flips bearish, it's going to provide me. Let me go to a 4-hour here. It expanded up. Again, we can see our levels, and it can start providing us continuity. Matter of fact, let's just do at least one more here. So this is another good example. This is a short trade that I've been in for a little while that I just haven't talked about. So this is Oxy, so Occidental Petroleum. So if we come up to January 15th, we have a 2 candle. And again, I don't use the Strat. I did end up entering the short roughly the same time as the Strat would have told me, but I used something different. We'll go into that later. But for the purposes of what you're doing or what you're learning, this is a great example here of a 2-1-2 reversal, right? And the 2-1-2s are going to be the things that you look for more than just about anything else. So we had a 2 up. We had a very small inside day, right? So we had a 1, and then we had a 2 down reversal. So I actually entered this trade on January 16th. So it would have been on the quote-unquote 1 day, although I did not enter at the time that it was known that it was going to be a 1. At the time I entered, it looked like it was actually going to be a 2-2 continuation day, but that's neither here nor there. So what did we see after this? We see an entire series of 2 down days, right? 2 down, right? What's it touch? It touches this level here. 2 down again. What's it touch? It touched this level over here. 2 down again. What's it touch? It touched this level right here. 2 down again. What did it touch? The top of this one right here, right? You can just trace this all the way down through your levels. And then we had a 2 up day. But remember, 2 up days are not considered reversals in and of themselves, right? You need some sort of a continuation where the following candle breaks above or below what the reversal trend is saying. So we had this 2 down day, and then we had a 2 up day on January 27th. But on January 28th, we had another 2 down day, and at no point did the candle eclipse the top of the prior days up to signal a continuation, right? So we knew the trend was still down, so we kept riding it and riding it. This trade here, I actually got out of it a little early. I got out of it on January 31st, but that was because I was doing something else. And again, we can walk these back to all these different levels. They will always hit, but this isn't really the point. This is just showing a continuation, continuation days, right? These are bearish continuation days. It wasn't until we had a significant 2 up day that it kind of signaled that maybe the trade was starting to flip. And then we had an inside day right here. So we had a 2-1. The inside day was also down, right? So it was still an inside day. It was still showing consolidation. And then we ended up with a 3-day, right? And remember, a 3-day is always a 2-day that fails, right? A 3-day is a directional day that starts off going one way, and then it ultimately gives up. So in this case here, the 3-day, this 3 candle on February 6th, eclipsed the inside day prior. So it looked like it was going to be a continuation day, but then the entire trade kind of swapped and ended up going out below the inside day, right? And it finished lower. So what does this tell us? This tells us that there was an attempt to reverse the trade, and the reverse failed. And then what was the follow through? It was yet another 2-down day. So until we see an inside day or a series of 2-up days, the trend here with Occidental Petroleum is still down, right? This is still a very, very much a valid trade from a short perspective, although it's kind of running out of gas at this point. Yeah, you got to go back quite a bit to find the next level. So, I mean, this isn't me saying that you should probably enter this trade, because again, like we're having to, let me go back to a monthly thing here. Again, we go for time frame continuity. So on a monthly, I'm looking at the next level is going to be 43.88. No, 44.04. So that's another couple dollars down. I mean, a decent trade, I guess. And if it continues down further from there, you're looking at it's going to be 39.41, and it's going to be 37.25. And it's going to be 35.93, right? So again, you're looking for these continuation patterns. You're drowning out all the signal noise. You're ignoring things like VWAP and EMAs and all of that crap. You're just going with what is universally true and working through on your levels. And this again, any one of these examples would have netted you a fairly significant amount of money in a trade had you followed through with them. Kind of close out the strat here with a little ending slide here. So when we talk about the difference between winning and losing trades, specifically when you're using the Strat system, losing trades are going to be trades where you get chopped up on inside bars, right? You get caught up in trying to play consolidation, and they just move sideways over time, and you don't get any sort of direction, you don't get any sort of movement out of rest. You've got a directional bar. You're looking at a 2-1-2. Maybe you look at it as a bullish continuation, and it turns into a bearish reversal. So you've always got to be cognizant of that, and that's going to be realistically the one that gets you the most. You're looking at an outside bar. So right, again, we're looking at a type 3 candle, and you pick the wrong reversal, right? Because again, remember, type 3 candles indicate a reversal of trend, but the amount of velocity that comes with one of those really has to come through feel and understanding and working your levels to see how much directional upside or downside there is based on that 3 candle. Again, until you feel more comfortable with the strat, I would kind of stay away from 3 candles. I would mostly focus on my 2s and my 1s. Those are much easier to work with. And then the last one that's going to get you is time frame continuity. Where you look at it from different angles. Again, I recommend looking at a month. I remember looking at week, day, and then hourly. I don't recommend going down below hourly until you're more comfortable with things. Because again, remember, this is mostly about swing trading, kind of longer term investing. That's what the strategy is based upon. So if you get chopped up on a trade, and none of these other things are true, right? It wasn't because one bars just kept happening for 12 days in a row, or you picked the wrong direction on something. You can almost always trace it back to the fact that you were just being retarded when you were looking at your time frame continuity, right? You didn't have continuity across at least 3 time frames, preferably 4. You were ignoring that. And again, remember at the beginning of this, I told you guys that most novice people are going to look at this as just a series of trying to find reversals in order to do their trades, and that's a good way to not exactly win because you have to be able to figure out your time frame continuity. Your winning trades is when you ignore the inside bars. You don't get caught up in
just seeing one and then assuming something immediately has to happen. Again, the ability to identify direction on directional bars, that's something you pick up with experience. And then, obviously when you've got time continuity as your friend, again, across multiple time frames, you get validation that your thesis is correct. And then the one thing I didn't put down here on winning trades, because this is something that until you're more advanced and realistically, until you have at least $25,000 in your portfolio so you can ignore pattern day trading rules, are the broadening formations, right? Broadening formations are a great way to day trade or even swing trade over short periods of time. As long as you've got validation that a broadening formation is being respected, you can ride one of those out for quite some time. Now, almost universally at the end, you're going to get bit on the very last trade you do in a broadening formation. It's either going to break out or break down. But by then, the idea is that you will have made so much money bouncing the ping pong ball back and forth from the top to the bottom of the line, especially as that formation expands, that your last trade being a loser isn't really something that you're even terribly concerned about. And this obviously goes into the fact that when you're playing things like broadening formations, make sure you keep your scales appropriate. Just because it's working for you every time doesn't mean you keep increasing the amount of money that you throw into it. Just because if you do that, when eventually it comes up snake eyes, and it will, if you've just sank all of your gains into this broadening formation pattern, you're going to walk out of it with nothing. So those are the things that you really got to worry about there. I know this sounds fairly confusing. All I can really say is spend more time than you think you need staring at these combo sheets. And there are more of them out there. If you've got more interest in the Strat specifically, there's plenty of YouTube resources, although I've watched some of them because I was hoping I could just give you guys somebody else's content. I wouldn't have to create it. The reality is most of it's terrible. There are a number of paid courses out there. I can't advocate for them because I don't pay for anything in this, just because I don't need to. But if this seems like this is the trading style for you, like this is as far as you want to go, this is certainly an effective one that can carry you across through the entirety of your trading career. So maybe look for what was Rob associated with? I think his group was called the Sepia Group, SEPIA. I think that's who he was associated with at the time. And I think they've got a course on all of this. Again, it's not the strategy I use. I mean, I took some bits and pieces out of it as I've developed my own style. So I wouldn't do it, but you guys have to make that determination for yourself. All right, lesson 6 is over.